Hi, I'm Trent Kling with the Retail Focus Podcast, here with this week's Retail Quick Scan. Ascena Retail Group was in the news last week after it was announced that they could potentially close up to 600 stores in the next 5 years. This was all after an earnings call as their president and CEO David Jaffe mentioned that because results weren't where they expected, they were starting an optimization plan with their store portfolio. Let's take a look at some of the earnings results, and really what stood out from Ascena Retail was their same-store sales hit. They operate multiple brands. You see Maurice's, Dress Barn, Lane Bryant, Justice, the teen apparel retailer among them. They have 4,850 total brick-and-mortar locations across their brands, but you see that the Maurice's brand fell 12% in terms of comparable store sales, and Taylor fell 7%, Dress Barn fell 8%, and Lane Bryant fell 11% as well. Now, their loss in comparable store sales, the company said, was attributable almost entirely to traffic declines throughout their store portfolio, dropping as much as high single digit to low double digit across their many brands. Basket size remaining relatively stable. So the company has decided to maybe optimize the number of stores they had already in the last quarter. They closed a net total of 28 stores. But when you look at the closure plan, this is a multifaceted plan that appears to be well thought out and well planned by the company. There is certainly a rhyme and reason to the stores they may be closing or could potentially be closing if they can't renegotiate the leases. Now, as we take a look at the closure program, they're looking to potentially add stores to their fleet optimization program based on several criteria. We're going to take a look at three. First, their comp store sales outlooks of negative mid-single digit compound annual growth rate. Those stores are going to be at risk of closure. Second, where they feel like 10 to 30% of the sales of that particular store could be transferred to another chain store. Those stores are also at risk. And then third, the cash-based net present value of the store. Basically, what we're talking about here is where there's negative net present value. That reflects a store they expect investment costs and operating the store in the future to exceed potential revenue from that store. Now, there are a total of 667 stores in this reoptimization program, and not all of them are going to close. And this is one of the misconceptions that was out there on a number of different news outlets last week. In fact, only a portion of these stores, 268 to be exact, are actually ticketed for closure. And this company considers those to be 100% exit stores. Those are stores that they're closing no matter what over the next 3 to 4 years. But there are another 399 stores that they may or may not be closing, depending on whether they can renegotiate their lease agreements. And in fact, a number of these lease agreements, as the company pointed out in this earnings release, were in fact up for negotiation or included an out clause within the next 3 years. Basically, what the company will do is approach the landlords to see if they can renegotiate the lease downward. And they're doing this in part because percentage of net sales based on occupancy rate for these stores in the program, 19.6%, which is pretty high for a retail store anyway, but certainly high compared to the rest of their store fleet, which sits at around 14.3%. Basically, what this means is that these stores pay a higher percentage of their revenue towards rent than any of their other stores in the chain. This can be for a couple of different reasons, either the rents being higher at those stores or the sales being lower at those stores, since those are the two inputs into that particular equation. But we wanted to take a look at why these stores are struggling. A lot of news outlets out there are blaming the overall retail landscape. They're blaming e-commerce for the struggles at Ascena Retail Group. And while certainly we believe that e-commerce is a big reason for their decline in sales, and we believe that overall retail softness in the fashion industry is a slight reason for decline in sales at some of their stores, we think there are other factors at play. And when we go back and look at those same store sales numbers, we'll put those on the screen for you again. Keep in mind that the largest losses came in their Maurice's brand, followed by Lane Bryant, and then you also had losses of 8% at Dress Barn, 6% at Justice. When you look at their real estate portfolio, Maurice's of these has long targeted smaller markets. In fact, markets as small as having 25,000 people in their surrounding area within about 20 miles from the store. Dress Barn, Catherine's, Lane Bryant, Justice, all of those stores in their portfolio target mid-size markets. And then when you take a look at some of the other stores in these small to mid-sized markets, some of these stores that specialize in these markets versus the larger markets, you can see a clear and potentially disturbing trend for real estate holdings in these markets. First, we take a look at Hibbett Sports. They specialize in small to mid-sized markets. They're seeing comp store sales declines of 4.9% in the latest quarter. Cato Fashion, numbers are even more alarming there. Their May same-store sales were down 16%. Year to date, their same-store sales are down 17%. And then Stage Stores, again, holdings with Goodies, Beals, a lot of those in smaller to mid-sized markets, they saw comparable store declines of 9.6% in the latest quarter. With the decline in Maurice's that we saw, with the decline in some of their other small to mid-sized market stores in Ascena's holdings, we think as much of the decline is attributable to a tepid retail environment in these small to mid-sized markets. And this is borne out certainly by looking at other stores that specialize in these markets. Now, the bad news long-term is that these small to mid-sized markets are going to have a lot of empty real estate. So it's bad news, of course, for the towns, bad news for the landlords. The good news for Ascena Retail Group is a lot of these 399 stores are in small to mid-sized markets. This gives them a lot of bargaining leverage with landlords to try and negotiate the leases downward because of the sales environments in these small to mid-sized markets. And if you're a landlord, maybe you'll renegotiate that lease if the alternative is having an empty building for a long period of time. We hope you've enjoyed this Retail Quick Scan. I'm Trent Kling for the Retail Focus Podcast. Check out our podcast. It's coming out later this week. We not only discuss this story, but also earnings from Kroger and a brand new store concept from Meijer. That podcast is brought to you by Third Wave Water. Check them out at thirdwavewater.com. Use the promo code FOCUS for 10% off your first order. It's what I used to make this very cup of coffee. Until next week, so long.